What's up, y'all? So today we're going to discuss the EMA. It's technically an indicator. It's called the exponential moving average. Okay, and we're going to be examining indicators. And indicators are, some people don't use them, but they are very important, and they can be important and very helpful to your trading journey. So indicators are basically this, okay? As you guys should know by now, the candlesticks are a direct reflection of the price of whatever that financial instrument is trading at. But there's multiple ways to assist you in helping determining the probability of it succeeding. You know what I mean? In other words, they have something called indicators that's designed to help assist your predictions, because these indicators are also calculated and formulated off of price. So whatever, if let's say, for example, if your price is trading at $75 a share, these indicators are the indicator's formula. The formula for the indicators are calculated based off the price. So these indicators should be confirmation to what price doing. It's almost like the indicators are serving as shadows to walk behind and be a reflection of price. You understand? So they help you determine the direction. You understand? Indicators can help you determine when reversals about to occur. And for you people who do not understand what reversals are pretty much turning points in a trend. So if there's a downtrend in existence, whenever that downtrend ends, there will be a reversal, meaning that downtrend can turn into a consolidation period. You know what I mean? Or that downtrend can start going up. So it can be going down for a period, and a reversal takes place when that particular instrument goes the opposite way. You know what I mean? For a significant amount of time. So that's what a reversal is. You understand? So indicators help you point out the reversal points, because they are a direct reflection of price. But all indicators don't move accordingly. Some of them do the exact opposite of what price does. And when that happens, we call that a divergence. But that's something that, we're going to get to later. Right now, we're primarily talking about a specific indicator. And it's called the exponential moving average. EMA for short. You know what I mean? And it's a very popular tool. You understand? So, if you guys have been paying attention, we already discussed the difference between the open, the high, support, and resistance. As you can see, I got the candles shaded in because I mentioned in one of my other videos, in one of my earlier videos, that most positive days are white and blue. And opposite, the red is associated with most down days. So these are positive days, But what we have here is the EMA plotted on price. Okay, so the blue line represents a 20-day moving average, meaning every 20 days, this formula was formulated to be a direct reflection of what this is doing. You understand? If you notice, when it went up a little bit, this went up. So it pretty much does the exact same thing that price does. But a lot of indicators are lagging, meaning even though they duplicate the same exact movement, or they're moving in the exact same rhythm as price, even though they're moving the same, it's a bit behind. So we call these indicators lagging. A lot of indicators are lagging. And when they lag, you want to put weight on them and so forth. But for the sake of showing you guys how this indicator works, we don't need to wait. You with me? Okay, so the second line, which is the green line, is called the 50-day EMA, or moving average. You know what I mean? Because basically, these three lines are a representation of a moving average. This is a 20-day moving average. This is a 50-day moving average, and this is a 100-day moving average. And if you don't know what a moving average is, it's basically the exact same thing as the EMA. You know what I mean? The only difference is the reason why they call it EMA is because you're combining multiple moving average. That's why they call it an exponential moving average. Exponential moving average. Excuse my terminology, but that's why they call it that. You know what I mean? Because it's just an expansion of a moving average. So it's using three, or combining three moving averages instead of one. That's it. Okay. So the last line, which is the red line, is the 100-day exponential moving average. You know what I'm saying? Or moving average. You know what I mean? And these lines are important because they help you determine which way the trend is going. You know, when the 20-day moving average is on top, typically it's an uptrend. So in addition to looking at price and, you know, looking at higher highs and lower lows, indicators also help you determine which direction the trend is heading to. And in particular, the EMA, when the 20-day is on top, it helps establish an uptrend. You with me? Vice versa. When the red right here is on top, it's a downtrend. You with me? So right here, we had an uptrend. Boom. A little bit of movement right here. Boom. It pulled back right here. Boom. It went up a little bit. It pulled back. Then it started trending up. You with me? Especially when price get under. So whenever the 20-day is uptrending, your 20-day is going to be under price. And likewise, your 100-day is going to be overpriced when it's downtrending. So it's underpriced. You with me? And if you're paying attention, once it shot down, it consolidated a little bit, then it started falling. If you pay attention, the red line was starting to shift and get on top of the rest of the lines. Right here. It was heading towards getting on top of the lines. So there's a continuation here. It fell, boom. Then the red line was on top of all the other lines. So when a downtrend is happening, let's say, for example, if this was going the opposite way, not up but down, then the red line would be on top, the blue, the yellow, the green line, would be in the middle, and the blue line would be at the bottom. Okay, this is a downtrend. This is a downtrend right here. All right, and how you know it's a downtrend? And when now, I will say this. You have to wait on confirmation of the downtrend or uptrend. And the confirmation is when the lines cross over. You with me? Okay, so like say for example, right here, boom, you would have your blue line, your green line, and your red line. See your red line starting to cross over your green line? When that red line officially crosses over that blue line, then you want to be mindful. You know what I'm saying? That doesn't mean that you take your entry there. You want to look at it. You understand? But it's approaching a downtrend when that happens. Whenever your 100-day crosses both your 50-day and your 20-day. You understand? That's the beginning of signs of a downtrend. You understand? Now, once it fully crosses over and that 100-day exponential moving average line fully gets on top of your 50 and 20-day line, it's officially a downtrend. Okay, now you can make your entries. Now you can get in. Now you can short the market. You know what I mean? Or in other words, sell the market. You understand? Now you can take an entry. You understand? So when people be saying, okay, when is the best time to enter? When is the best time to get in a particular trade? When is the best time to buy a stock? When is the best time to buy a currency pair? Okay, this is how you determine when the best opportunity presents itself. It's simply by reading Forex. Reading technical analysis. You know what I'm saying? You can read Forex too, but basically technical analysis. And right now we're talking about the EMA. The EMA will let you know when a trend is in existence. The EMA will reveal everything to you if you sit back and let it. You understand? It ain't hard. It's not hard. You understand? You have your 100-day, your 50-day, and your 20-day. You understand? Now, when you're in an uptrend, and your 20-day is on top of both your 50-day and your 100-day, you with me? It's typically going to be under price. You understand? Like right here, it's under price. You understand? Now, this is further confirmation to an uptrend. The fact that it's a strong uptrend. Now, even if it pulls back to this line, so meaning even if it goes down a little bit, even if it goes down all the way, even up to here, the uptrend hasn't officially ended yet until the 100-day crosses over the 20-day. So until that happens, you're still bullish, meaning that don't necessarily mean that you got to stay in a trade now. That's a whole nother subject, and that's something we're going to discuss later. But in the meantime, until that 100-day EMA crosses that 20-day EMA, you're bullish, meaning you are buying. You are anticipating for price to continue to go up, despite the fact that it dropped a little bit. You understand? And for those of you who just hearing the term bullish, if you're interested in learning about trading in general, this is an important term. Bullish, bearish. Bullish basically is you're long. Long is another term for buying, meaning you're predicting the future price to exhale. You understand? Excel. You're predicting a future price to go up. You with me? That's bullish. That's associated with being bullish. So whenever you hear or whenever you watch CNBC or CNN and you hear a stock market expert talking about being bullish, he's basically saying that he's anticipating the price of that particular stock to go up. You understand? Now, the term bearish is associated with the exact opposite. It's associated with down. So if you hear an expert saying that they're bearish, they're basically saying that they anticipate the price to drop and not go up. You understand? So bullish and bearish. Bullish and bearish. These are important terms that you're going to have to know. So bullish and bearish, you know what I mean? But back to the situation at hand, having a EMA plotted on your chart is, in my opinion, is essential. You understand? Now, you don't need it. You don't technically need any indicator. And this is something that a lot of traders preach. They teach about you not needing any indicators, because some traders argue that indicators cause a further distraction. And to some degree, I will agree with that. You know what I'm saying? If you're a beginner, my advice is to start off identifying support and resistance. You know what I'm saying? Because that's going to help you determine where the real supply and demand is. Because the price is key. I will agree. But in terms of the indicators not being usable at all, that's where I disagree, because the indicators can provide you a great sense of surety in addition to price. And indicators can give you a great heads up about the future movement of a particular price. Indicators can show you things sometimes that price can't. You with me? So, in my humble opinion, indicators are very needed. You know what I'm saying? Although they are instruments that don't have to be used, you know what I mean? In order to trade the way that I'm going to show you guys to trade, you need indicators. So my recommendation is to use them. You know what I'm saying? And specifically the ones that I'm going to show you guys how to use. You know what I'm saying? So, in short, the EMA is basically 3 or less. You know what I mean? As long as it's more than 1. The EMA is basically an expansion of a moving average. You know what I'm saying? And a moving average is basically an instrument priced and formulated to be a direct reflection of price. You want me? So it's going to help you determine what price is doing, in addition to you looking at price itself. So in addition to you looking at these candlesticks, you have a now plus. So think of indicators as a plus. You with me? That's it. You know what I'm saying? Think of indicators as another individual. When you can't see something fully for yourself, you might have, or you might need someone to point something that you can't see out. So think of it as having backup. Thinking of it as you come into a fight, not only with yourself, but you come in with a weapon. You know what I mean? You come in with a person. You come in with someone who can see something that you can't. You know what I mean? And even if they do see exactly what you see, then it's confirmation that you're not wrong, because you have another individual confirming what you already see. So think of that another individual as an indicator. That indicator is here to serve you as backup in your journey, in your fight. Your fight against these institutional investors. Your fight against the banks. Your fight against the traders who are representing these banks. So use as much artillery as you can. You know what I mean? You know, you can succeed without, heavy armor and a lot of artillery. You know what I mean? Because David did slay Goliath. You understand? But if I have the option, I'm not going to bring a knife to a gunfight. So, take my advice and don't bring a knife to a gunfight. You know what I mean? Fight the good fight with the proper weapons and the proper tools. You know what I'm saying? These are additional tools and they're indicators. So I want to wrap this up. Appreciate you guys as always. And until the next video, peace.